The S&P 500 is 7% away from all-time highs as we head into Q2 2023 earnings. Now, if we take a look at Q2 2023 projections, this is supposed to be the lowest forecast consensus for any quarter, including the actual data from 2022, the projected data for 2023, and the projected data for all of 2024. Will we see a pullback on the S&P 500 and the broader market? Is this going to somehow take us back to the bear market lows of October 2022? In my opinion, of course not. So what are we to expect going forward now that we know that CPI is dropping like a rock? The last reading was at 3%. Remember, this same time last year, we were over 9%. And if that's the case, then why is the Fed still projected with a 96% probability to hike rates once again on July 26th, if inflation is, as a matter of fact, coming down as violently as they say? In this quick little video, I will give you my projections for the market, where I think there are opportunities in certain stocks, whether you will have a chance to buy at the discounts again, and some of the strategies that we are now utilizing based on the fact that we are in a bull market. Our trading strategy looks a lot different when we're talking about swing trades than they did, say, all of last year. So without further ado, let's get right into it. What is going on, traders? Welcome back to The Traveling Trader. Currently in Las Vegas for a poker tournament, as you see by the ugly curtain in the background. Took a couple of weeks break off of making videos, but we are coming back to it full force. I've been busy with our personal mentorship program, taking less than 20 students through an entire intensive, immersive coaching program, 8 weeks, 2 times a week. We go over technical analysis, trading, options, and futures. This is jam-packed with a very tiny class. If you want to get on the wait list for the fall program, make sure you click that link below and we will send you the details as soon as they're available. So as I said, the S&P 500 is 7% away from all-time highs. Now, if you remember what I said in terms of my analysis for most of this year, I said if the Fed actually pauses in June and the debt ceiling is resolved in time without pushing it till the last second, 4,500 is our target for the S&P 500. That is where we currently are at if you look at this chart. Now, I also said that historically, when we are past the golden pocket on the Fibonacci scale on the daily chart, in history, we have never ever fallen back to a bear market. Now, obviously, there are different bear markets that have taken a much longer time to get above this level, but regardless, whether you're talking about 2008, 2000, 2020, whatever, once we cross above the golden pocket on the Fibonacci scale, we never ever fall back into a bear market. And we are now in a solidified bull market, as we are more than 20% from the lows on both the NASDAQ and the S&P 500. Now, as I said at the intro, according to FactSet, Q2 2023, which is starting now as of the time of this video, earnings season officially started for Q2, is projected to be the worst quarter for all of next year, the rest of this year, and compared to the actual data from last year. However, here's why this could still drive the market up higher, because if you are projecting it to be way worse and it comes in better than expected, well then, hey, you have good news. And we are already seeing some signs of this because Delta Airlines, which posted its highest ever revenue and profitability for Q2 2023, which was supposed to be the worst quarter of last year and the next year projected. Also, the banks have absolutely killed it. We see JP Morgan, Wells Fargo actually boost their forecast for earnings as well, because now the higher interest payments are starting to come in and we aren't seeing a credit crunch just yet. Also, obviously, the Fed came in and saved the banks and basically opened up their lending program, which is why the Fed's balance sheet actually increased earlier this year. But we now are starting to see those banks paying back those loans to the Fed, and the Fed is back to the level it was before it started lending banks these loans so that banks actually don't fail. Now, in my view, that's part of the reason why we didn't get a recession yet, and that's part of the reason why the rally was fueled, because the banks actually were saved by the Fed. If the banks were not saved by the Fed and we continued to see failure after failure, then we could have seen a completely different picture. In my view, we would not have crossed above this golden pocket here. We also might have revisited close to those October lows if banks kept failing. Now, not only did I buy the financial sector of the S&P 500 when the banks actually started failing, because as soon as I realized that the Fed was going to step in, the banks, at least the big banks, would not be facing the issues that the regional banks were facing, and that this drop right here was an overreaction. So we are up almost 8% on our XLF investment. And because I thought Delta Airlines airlines beating earnings was likely a precursor that the banks could also beat expectations. We bought the JP Morgan July 14th 150 calls and made 64% on those. If you want access to all of my insights, my options picks, my stock picks, my day trades, etc., link is in the description below. Make sure you book a call with an ambassador and apply to the academy and see if you are approved. So I think we've answered the question so far. Are we going to go back to the October lows? In my view, we are not. We are not even going to go back into a bear market. Now, the only thing that can change this for me is a black swan event. And there are two things that I'm watching very carefully here. One, why the fuck is the Fed continuing to raise rates if we truly came down from 9.1% to 3%? Well, to me, it's clear it's because the jobs data keeps coming in defying the Fed. The Fed wants to crush jobs. Now, are they doing this really because they want to tame inflation? Well, if inflation is trending, and by the way, we've never in history gone from a high of near 10% to the low single digits. That has actually never happened in history. There's a whole other discussion whether you actually believe the numbers or not, but let's just leave that aside for now. If the numbers are to be true, why is the Fed actually looking to still hike? Because they will still hike in July. Now, whether they hike again in September is anybody's guess. But they are looking to crush the job market. And again, are they crushing the job market because of inflation? No, in my view, there is actually an ulterior motive. And the motive here has to do with employees that are empowered. Obviously, how do employees get empowered? Employees are empowered when wages are high. And right now, if you look at wages are higher than they have been at least since 1998, going back probably before that, but we have the highest wages that we have seen in 25 years or so. So in my view, the Fed wants to actually crush us. Now, whether they're doing it as a favor for corporations or whether they're doing it really because they just want to ensure that inflation is crushed and that there's no more spending power left, the truth of the matter is that is why they are going after more rate hikes, even though inflation is down to 3%. So I'm watching that very carefully because the Fed, if they do hike again, then obviously that shows that they are not afraid to crank the dial up on interest rates. And the second thing I'm watching is something that I actually mentioned just a second ago, and that is the Fed's balance sheet. Is the Fed actually even committed to knocking this down? I mean, this is still at $8.4 trillion. We were supposed to be way further ahead in terms of knocking this down. Obviously, this little spike that you see here is the loan program that they opened up to the banks so that banks actually stopped failing, and they said, hey, we're going to open up the spigots, borrow as much as you want, which created a liquidity event, meaning they pushed more liquidity into the hands of the economy. That liquidity found its way into the markets. So as I said, it shows now that banks have started paying off those loans, but we are now back to the point that we were before the banks started failing and before the Fed opened up this loan program. So what happens from here? Is the Fed actually going to start knocking this down? So the combination of the Fed actually knocking this down with turning up the dial on interest rates is something I'm watching. Now, I'm not saying that this is bearish, all right? So those of you in the comments that are like, oh, you said that the Fed is going to do this and that the balance sheet is going to drop and that we're going to crash to hell. No, that's not what I'm saying. I'm saying that these are things that I'm watching because the Fed can easily, and they've done this before, ignore the balance sheet. They could just say, we're done hiking, we're done tightening, we're ignoring the balance sheet, right? They can easily say that. And if that's the case, then, we're back to all-time highs on the S&P 500. As simple as that. But if the Fed is actually committed to knocking this down by the $90 billion a month that they said they would, and they start turning up the interest rate dial here, then I'm going to be watching for at least a potential pullback in the markets. And if this data right here, which doesn't seem to be true so far because earnings have been crushing it, at least in the early stages, if this data is true, then that pullback could come as early as this summer right now. Now, in terms of a pullback, let us see what is possible. I tweeted this. By the way, follow me on Twitter for free daily trading and finance content. You will not regret the follow. Instagram as well. But on Instagram, I do post more travel stuff. So if you're interested in a little bit of entertainment, then follow me on there as well. But here's what we can expect from a pullback because we have historical data going all the way back to the Great Depression. When we enter a bull market, since 1949, there's only been one time where the S&P 500 was lower. That's it, after hitting a bull market, and that was 2001. So after we hit a bull market, usually, at least going back to 1974, it is the norm that we tend to see a pullback within at least 3 weeks of us hitting that bull market. But don't expect, as I said, don't expect anything like going back to the October lows. The average pullback, if you take a look at it here, we're talking about in the single digits. In 1988, 3 weeks later, it was a 3.5% pullback. Obviously, I said 2001 was an anomaly. 2002, it was 7.9%. 2008, it was 4.4%. 2009, we didn't even really have a pullback. And then in 2020, same thing, but that was an anomaly because the pandemic was the craziest thing that I've ever seen as it relates to the markets. So in my view, if you are looking to invest, I think that you should invest in the S&P 500 every time we see a drop to a point of interest. Whether you use moving averages, you could say every time we get to the 21 EMA, I'm going to invest a little. Or you can continue to dollar cost average regardless of what the S&P does. But for me, I like a little bit more of a deliberate strategy where I add heavier on these pullbacks. Another thing that I'm doing with the group is selling cash secure puts. We sold cash secure puts on Tesla. This is something that I will be doing likely weekly because it is an easy way, in my view, to earn income during a bear market. Selling a cash secure put means that you are selling a put lower than the current market price of, say, Tesla or any stock you want to own. And if that price never gets hit, you keep the money that you sold the put for. In this case, these puts were around $400 each. So depending on how many puts you sell, depending on how large your budget is, you're collecting a free $400 for every contract that you sell. Now, what is the drawback? If Tesla falls to this level of this put, let's just say 252.5, then you will be forced to buy 100 shares of Tesla at 252.5, but that represents a significant discount from where we are now. So it's a great way to earn income while potentially jumping into your favorite stocks at a discount. So that is what I'm expecting from the market. I'm not expecting a bear market. I'm expecting just small pullbacks. However, I'm monitoring those two things very intensely like a hawk, which is the Fed's balance sheet as well as the Fed rate hikes. And I really want to see what Q2 2023 earnings are like. If Q2 2023 earnings are subpar, that could provide even a further opportunity to jump in if we get a more significant pullback. Like if we get a 10% pullback in the market, to me, that is going to be a gift in a bull market. And of course, we'll be sending out our earnings plays in the academy as well. If you want to trade with us live, if you want access to my stock analysis, you want access to the options plays, the cash secure puts, the day trades, the futures trades, etc., make sure that you sign up to apply to the academy below. And if you want to get into my fall mentorship, less than 20 students, we do not take more than 20 students. We keep it small to make sure that everybody progresses at the same rate, and we turn you into a better trader guaranteed after 8 weeks. If you want access to that wait list, that link is also in the description. Put it in the comments below. Let me know what you think for Q2 2023 earnings. Let me know what you think for the S&P 500. Do some of you still believe that we will fall back into a bear market? Do some of you still believe that this is a fake out? Do you believe that we are in a full force bull market? Would love to hear from you. I try to respond to every single comment. Wish me luck out here in the World Series of Poker. I'm gonna try to represent you guys. I actually randomly bumped into Uncle Larry, stock up with Uncle Larry in the casino downstairs. So shout out to Uncle Larry. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.